There are several ways to fund your new self-directed IRA, including via a transfer or a rollover. There are distinct differences between these two that we'll explain in this video. A transfer is when one retirement account moves from one custodian to the same type of account at a different custodian. In addition to being the same type, the accounts must also have the same owner. This custodian-to-custodian transfer is a non-reportable movement of funds. No Forms 1099-R or 5498 are issued because the transaction is simply moving funds from one like account to another. The funds are paid from the other custodian to next generation on behalf of your account. For transfers into a new self-directed retirement plan at Next Generation Trust Services, you must use our transfer form found on our website under Client Forms. Next Generation then executes the transfers on behalf of our clients' IRAs. Transfers can occur an unlimited number of times, which is an important difference between these two types of transactions and rollovers. There is also some flexibility about transfers between traditional and SEP IRAs and EP and simple IRAs that our helpful staff can explain. Checks are to be made payable to Next Generation Trust Services for benefit of, followed by the client's name and IRA number issued by Next Generation. A rollover is when funds leave the current custodian as a distribution and are received by the new custodian as a rollover contribution. Rollovers are used to move funds between non-like plans. For example, you might have funds in an existing 401k plan which you can roll over into a traditional IRA that you have at another custodian. There are two types of rollovers, direct and indirect, done for different reasons or in different situations. In either case, you must use our rollover form found in our Client Forms section of our website. You must also contact your current custodian and then have them initiate the rollover. A direct rollover means the transaction occurs directly between custodians. The distributed funds are sent directly to the new custodian. Making a direct rollover can help account holders avoid mandatory withholding of taxes required for certain distributions. In an indirect rollover, the account owner personally receives the distributed funds first and then deposits them into the new retirement account. Indirect rollovers must be completed within 60 days after receipt of funds. Note that, unlike transfers, each account owner may only execute one rollover between IRAs during a 12-month period. Either type of rollover is a reportable movement of retirement funds. Your custodian will report this transaction on IRS Form 5498. Our staff can answer your questions about the differences between transfers and rollovers, or how to complete the forms correctly. However, we recommend you consult your tax professional about which type of transaction is the best tactic for you based on your individual situation.